Hey, what's going on, guys? So today I'm gonna make a video about market psychology. A few people have asked me about that, and people they always think it's some kind of like indicator or strategy or certain candlestick pattern that is like what you always do and it's always going to work out and everything like that. And those things matter, and technical analysis is definitely important. But understanding psychological concepts that go into all this is really more important and being able to manage your emotions and being aware of these things to understand like you're a human. You can't help but to have these emotions and these feelings and these certain psychological concepts. So the best you can do is to be aware of them. That's really all you can do is to be aware of them, understand how they affect you. And I came about a lot of these from just experience and doing this, but also from several books that I've read. And one of the books is Thinking Fast and Slow by Daniel Kahneman, and it's a really good book. It's not about trading necessarily. It's more about just psychology, and they do talk about how the different concepts relate to financial decisions normally. But it's just a great book overall to read. Another book is Anti-Fragile by Nasib Talib, and he was a trader for like 20 years, like a pro trader. And so once again, it's not about finance necessarily, but a lot of the points have really been beneficial and helped me a lot. And some of the things that I'm going to talk about, this is going to make two videos, and then the other one is The Psychology of Money by Morgan Housel, I think his name is. So these are three great books to read if you want to further your knowledge and your horizons on these concepts. All right, guys. So we're going to get right into it. Sunk cost fallacy. This is a really important one when it comes to investing and trading. So let's read just what it says on Google. When you Google the definition right here, the phenomenon whereby a person is reluctant to abandon a strategy or course of action because they have invested heavily in it when it is clear that abandonment would be more beneficial. The sunk cost fallacy creeps in a lot into a lot of major financial decisions. So it's not a concept just about financial decisions, but it even says right there on Google that it's notable when it comes to financial decisions. So let's come over here to investopedia.com. What is sunk cost fallacy? And we just read the definition. We don't need to read that again, whatever it is they say. But there's a few points here in the key takeaways. So sunk cost fallacy is the psychological barrier that ties people to unsuccessful endeavors simply because they've committed resources to it. And this next bullet point, examples of sunk cost fallacy include salaries, insurance, rent, non-refundable deposits, or repairs, as long as each of those items is non-recoverable. So an example of this would be like in non-financial example from these examples they just gave on investopedia.com with the deposit, for example. So like you live in an apartment and you stay there, even though the rent could be higher, you could have other issues with neighbors, something like that, but you're like, well, I've already paid the deposit, or they talk about insurance, that can be one. The example that I heard one time that was a really good example was like, say you bought a trip to another country and it was on a budget and the accommodations were just okay, and you paid $3,000 for it. And then say you got a deal for a $10,000 trip for 2,000, like some kind of promo or something like that. Most people would, but your first trip was non-refundable. Most people would actually stick with the first trip that they've already paid $3,000 for, that is not as nice as what they could have upgraded. Even though total value, you put them both together, it's still a great deal. So and this comes, when it comes to investing, obviously people, that's why they bag hold. They lose the money on it and they can't come to grips with losing the money. It also, this goes into like relationships. I've been with this girl for 2 years, whatever the case is. I've already invested this much time in it. I don't want to lose the time I've invested in it. College students, I've been to in school a year and a half. I don't want to lose this time that I've invested in going to school, even though if you keep doing something you don't like, it ultimately, you're losing more time. Same thing with bad investments. Ultimately, you're losing more money or not putting it into something that's going to make you money because you're sticking with a bad investment. So this is from the Harvard Business Review about how susceptible you are to sunk cost fallacy. Um, so we don't have to read the whole article, but this is they're writing about it, talking, and they're talking about in terms of all kinds of things, business, and stuff. So it's a popular concept. It's definitely something to know about and relates to investing. All right, so on to the next one, anchoring effect. So we're here at like one of the simplest resources on the internet, Wikipedia. So let's read the definition of what they say. The anchoring effect is a psychological phenomenon in which an individual's judgments or decisions are influenced by a reference point or anchor, which can be completely irrelevant. Both numeric and non-numeric anchoring have been reported in research. Okay, so some examples of this. So this talks about one of the books I referenced in the beginning, Thinking Fast and Slow. And one of the examples from the book talks about a couple here. But one was they asked students the percentage of African nations that were in the United Nations, and then spun a roulette wheel, and it will stop on either 10 or 65. And participants whose wheel stopped on 10 guessed lower than 25% of the time on average. Participants whose wheel stopped on 65 on 45% of the time on average. The pattern held in experiments on a variety of subjects. So the some of the ways on how this relates financially. Let's look at Investopedia. It's just easy, simple resources. All this stuff's free. And reading the book, that does help, but you certainly don't have to. So anchoring is a behavioral finance term to describe an irrational bias towards an arbitrary benchmark figure. This benchmark then skews the decision making regarding a security by market participants, such as when to sell the investment. Anchoring can be used to advantage sales and price negotiation, where setting an initial anchor can influence the subsequent negotiations. So understanding anchoring in the context of investing, anchoring is that market participants with an anchoring bias tend to hold investments that have lost their value because they have anchored their fair value estimate to the original price rather than the fundamentals, aka bag holding. And this is why you have to understand this. This is also goes into like the buy the dip mantra, which anyone who follows me know that I don't preach the buy the dip. You don't want to just buy red candles. People, and this is also why people get stuck in like a bear market mentality as the market moves on to the next phase. And then by the time they get bullish, they've referenced all their biases to higher prices and things start going down. That's why people buy a downtrend the whole way down. This concept is really important in the end, because I feel this is what makes people, the sunk cost fallacy as well. But this is like why people buy the dip. The sunk cost fallacy is why people don't sell things that they've been down on a lot. This, I feel, is more why people buy a dip that ends up being a downtrend. And I like to show further articles and reading on these things. Here is a article by the Federal Reserve Bank of St. Louis on the anchoring effect. So these aren't things that I certainly haven't come up with. They're easily to read and research on. And anchoring effect is an important one. As I said, I think it's the main reason why people end up bag holding. And the best weapon that you can have against it is to learn technical analysis, because then you have a reference. You try to block things out, just look at what's on chart. If you understand technical analysis, then you can at least get a reference on what the price is doing. You'll be able to tell if not buy a downtrend. So anyway, that is the anchoring effect. All right, guys. So we're back with confirmation bias and overconfidence. They're technically two separate concepts, but I'm going to put them together all in one because they're very similar. And if you don't already follow the channel, please give me a follow and thumbs up to help promote the video and the channel. So confirmation bias, what is that? So just simple Google definition. What does it say? Confirmation bias is a tendency to search for, interpret, favor, and recall information in a way that confirms or supports one's prior belief or values. So this is very common in the crypto market. I see it every day out there on Twitter. Go back to Investopedia, these easy resources, and look at some of the things that They talk about key takeaway. Confirmation bias is a tendency of human beings to actively search for, interpret. Okay, that's basically what we just read. Confirmation bias flourishes because it's efficient way to process information. It promotes self-esteem and it eases stress by eliminating conflict and contradictions. That last sentence is what's important there. Eliminating conflict and contradictions. Investors should be aware of their own tendency towards confirmation bias so that they can overcome poor decision making and seeking out contrarian views, avoiding affirmation questions are two ways to counteract confirmation bias. And we look at what Investopedia says about overconfidence. It's basically the exact same thing. Recognizing and understanding overconfidence basis is crucial to improving, making better decisions. Overconfidence, where that differs a little bit, would be like following people. I think like, okay, I follow this guy, he called this move perfect, like how do you do that so he can't lose, I'm going all in on him. There's all technical analysis greatly improves your probability, and experience in the market can as well, but nothing is ever for sure. And I think overconfidence and confirmation bias especially, it's another concept to make you bag hold. So when there's, I'll tell you a few examples. Recently, hello, I had there was a bad candle on the daily and it closed on the weekly, and I said on chart, this is a no for me. I'm getting out. I'm not putting my money here. I mean, hello will probably eventually go back up with the market, but it's going to be a lot of sell pressure. It's got to get through this breakout candle on the weekly. I'm not going to mess with it. I'm getting out. But here's what a lot of people do in those situations. When there's these bad dumps or whatever, they run to Twitter and they go to these threads or Telegram or whatever, and these people get together and they confirm each other's biases. They tell each other why it's okay. Or YouTube influencers that or have confirmation on a project, they'll get out there and they'll tell you fundamental reasons why it's all going to be okay. And fundamentals are great, and you want to invest in things with good fundamentals. But if you don't know technical analysis, then you're out here naked. That's how I feel anyway. You need to know both. And Hello isn't the only example. There's a few projects, Router, whatever it is, that they have these bad candles on the dailies and weekly, and I'm getting out. I'm putting the money in something that looks better, in these kind of market conditions, especially. So confirmation bias is something, you don't want to fall in love with any of these crypto altcoin projects. No matter how revolutionary it sounds, I have yet to see a crypto altcoin that supersedes and separated itself from the market. I mean, sure, there's some that have had gains and go up while Bitcoin's going down, but there hasn't been an altcoin that separated itself from the crypto bear market or anything like that. I think as a rule of thumb, you shouldn't keep, and I wouldn't even do this much, but 20% in one altcoin, because then you become too close for it. And like we talked about at the beginning, these things you can't help but for these things to affect you. Especially if you have a lot of money in something, then the confirmation bias comes in even more because you hope, and if the chart is telling you that it's not going to happen or it's no, or the probability is low, then personally, that's what I do. I listen to the chart and I'm aware of these biases like confirmation bias. All right, guys. So we got another good one here. Black Swan. This was a popular topic here, with the halving coming up and what had happened right before the last halving. We're going to talk about that in a second. So two definitions here. Obviously, we're not talking about an actual black swan. So we're talking about an unpredictable or unforeseen event, typically one with extreme consequences. The bank's industry vulnerability to a black swan. So it is by very definition a unpredictable event, and this isn't a debate 12K Bitcoin or anything like that, but I was not an advocate when people kept saying we had to have another low, I go by what's on chart. That was not what I was seeing. And I had said, we're going up to 48K throughout this whole run up when a lot of bears were still calling for 12K. And here's the point that like if this COVID low was a black swan, which I think most conventional thinking does consider it a black swan, then it's an unpredictable event to start with. And then you're saying that we're going to repeat that, it just didn't make logical sense when you understand the concept of what a black swan is. So when let's go to Investopedia, like I said, we'll keep it simple. A black swan is an unpredictable event. Like we said, key takeaways. They're extremely rare events with often with large negative consequences. A black swan cannot be predicted in hindsight, but may see, or cannot be predicted beforehand, but may seem obvious in hindsight. So by very definition, it can't be predicted. And this talks about, so this isn't the Anti-Fragile book I referenced, but it's the same author. And he wrote a book called Black Swan. And he even says that sometimes it's so rare that the possibility that this event would occur is not even known. And in his book, Anti-Fragile, he talks about kind of in cliff notes, like the worst thing happens eventually, and you need to let those things make you stronger, not weaker. So you can be resilient to issues, and that's good and everything. But you want like to be, when those issues happen, to not just be resilient. They want to make you stronger. So an example is like your muscles. Like they don't get stronger from rest; they get stronger from stress. So that's an example of like an anti-fragile system. Not to get into a whole thing, but the reason I say that is because, we're going to have a little fun here, just real quick, this next little part with Bitcoin. When you talk about black swans and financial markets, that if a black swan can make it stronger, like when you think of finances, how could that even be possible? And like I said, this is a little part here, just got some fun. So Kevin O'Leary, I mean, I'm not saying listen to what this guy says, but in this context, he's not promising price targets or anything like that. So Kathy Wood says 1.5 million Bitcoin, like she's a perma bull, not saying anything about that either. But the U.S. economy would have to crash, Shark Tank investor Kevin O'Leary says. In the context of this interview, and I did watch the interview, I don't know that, because he's a complete, market manipulator. Like, don't believe anything he says about prices and projections. But in this case, he's saying, like, in response to her Bitcoin target, well, for that to happen, the economy would have to crash, i.e. kind of like a black swan. So could Bitcoin really be that anti-fragile system that a black swan would actually benefit and make it stronger? And I'm not necessarily suggesting that. Like I said, just have some fun with that. And that is a black swan in a nutshell. Hey guys, I noticed when I recorded that clip just now that I didn't switch screens right here. So this is the article I was referring to with the Kevin O'Leary quote. That's all. All right, guys, we're going to finish the video with a simple concept. Simple but effective. And it actually says right here in simplest terms. It consists of reviewing your expenses and keeping only those that are key for you, using the rest to achieve your life goals. So there's not as much info about this, but basically, it's very important. It can save you a lot of emotional stress. And some examples of this are checking your balances too much. And one remedy for this is understanding multiple time frames and pick a time frame that you're going to base your decisions off of. So for example, in crypto, I go off weekly and daily charts, and even you can say monthly. So you say like the weekly is the main time frame that I base most of my decisions off of, and then I look at the daily and monthly, and I'm aware of those. So if I'm not looking at the hourly to base my decisions off of, then I don't care about the hourly chart. I tell people all the time, what are your goals? And if they aren't down to the hourly level, then don't let the New York Open of the market throw you around and throw you for a loop. Tell people, don't look at your balances or even look at crypto between, say, like 10 to 12 Eastern Standard Time most days, unless you're a day trader. Because if you're a day trader, that's the best time to do it. But they're looking at different time frames. So less can be more with checking your balances too much and just having your emotions going everywhere. Have a time frame that you kind of want to go off of, and like just naive interventionism in a bull market can be not good. If you believe prices are ultimately going up and your goals are top of the bull market, let's say, then you don't need to stress about it every day and look at your balances and obsess about these things. And, you want to look at the bigger time frames and make sure that the market's still going in your favor overall. And I just want to play this guy. His name's Arjoio. I don't want to pronounce his name incorrectly. He's from like a European country, but I just want to play this real quick because he's saying very similar to what I'm saying here when it comes to less is more.
Always tell you, yes, psychology is super important in your trading, but let's just not pay attention to it. Well, they don't say that, but that is the act that they're doing. They're saying psychology is important, but let me learn more concepts. We solve our psychology problems by using less concepts. If you're distracted by the chart, 1,000 concepts in your mind that you need to pay attention to, you're already stressed about, am I not missing this macro? Am I not doing this correctly? Imagine then you need to all of a sudden risk 5,000 on a trade. It's not going to work. If we just
So yeah, you see his video, give him a follow. I just came across his video by doing some research on my video, but just reinforcing basically saying that kind of thing that I said. And people look at my chart, you never see a bunch of indicators up there. I have a few EMAs up there, just kind of for like general reference. But you're looking at too many things, too much info. Pick a strategy, pick a way of doing things, pick a way you want to go about doing business, and stick to it, because sometimes less is more, and you just listen to too many different points of view and taking in too much info and looking at too many indicators. Pick a strategy that works for you and stick to it. So with that, I appreciate everyone who watched the end of the video. If you're interested in my Telegram, hit me up on Twitter or Danny the Bull. I also have a link down in the description. Also some referral links, MEXC, VPN, all those good things if any of that interests you. And thanks for everybody for tuning into the video, and later.